people with as little as £3,500 in savings are suddenly being hit with unexpected tax bills, and HMRC is sending out notices as we speak. Today, I want to highlight the Personal Savings Allowance, which is known as the PSA. It's just not as generous as it might sound, and it's important you keep informed with this one. Right now, this is the situation under the PSA rules. If you earn less than £50,270 a year, you can earn up to £1,000 in savings interest tax-free. But earn more than £50,271 and that just drops to £500. And if you earn over £125,140, your allowance is exactly zero. That's right, every single penny of interest is taxed. Lovely. And here's where the trap gets sneaky. Say you put £3,500 into a 3-year fixed savings account with a 5% interest rate. You let it sit, you don't touch it. 3 years later, the interest, well, that's around £525, is paid out in one go at the end of the term. Now, here's the problem. Because it's a fixed account, all of that interest counts in a single tax year. You've just gone over your £500 allowance, and that means tax. Even if you didn't earn any other interest, even if it's your only account. And the really worrying thing is, HMRC already know. Under the current rules, banks report interest data straight to HMRC. It doesn't matter if you didn't notice or you thought the interest would be spread over multiple years. They can see it. And when they can, you'll get what's known as a nudge letter, urging people to register for self-assessment or pay up on the additional tax they didn't know they owed. And it's not just a one-time bill. If you go £100 over your allowance and you're a higher rate taxpayer, you lose 40% of that. £40 gone just like that. And if you go £500 over, then it's a whopping £200 in tax. And I'm afraid it doesn't stop there. If you don't respond to that letter in time, you could face penalties and interest on top. And I think it's just a little bit ridiculous. But it's just a bit of interest. Yeah, and that's the issue. This isn't about investment portfolios or luxury incomes. It's catching out completely ordinary savers who didn't realise they were walking into a tax trap. The system doesn't care if you're just trying to beat inflation with a fixed rate. If the numbers cross the line, you're on the hook. So what can you do? Well, my advice is know your PSA, what I've been through in this video, especially if your income has crept up. Be smart about fixed accounts. Remember, all interest lands in one tax year. Spread your savings if needed. ISAs, premium bonds, and drip paying accounts can help avoid interest clumping. Keep track of your total interest across all your accounts, not just one. Because one quiet savings move today could be the reason HMRC comes knocking next April. If you want to stay ahead of HMRC's latest tactics, and I really recommend you should, then take a look at my video, Can HMRC Check Your Bank Without Permission? Trust me, the answer is going to make you think twice, because honestly, HMRC is watching, and most people won't even realise until it's too late.